Good afternoon, dear all. It's our pleasure to welcome you all on this client call organized by CBRE Romania. We hope you and your dear ones are all well and that you have adjusted to the extent possible to the current situation. We at CBRE would like to once again thank you for joining us for today's call. Our objective with this call is to brief you, as our clients, on what we see happening in the market due to the current corona pandemic. For this, we have brought in the proverbial, between brackets, artillery in the person of Jos Tromp. Those of you who were attending our client event early February in our office know Jos as our head of research for continental Europe. Besides Jos, our speakers for this call include Luisa Moraru, who is our head of CEE property management, Razvan Iorgu, who is our managing director for Romania, and myself, Gijs Klomp, head of investment properties for Romania. Our audience today includes developers and investors, but also representatives of the real estate financing industry, between brackets, the bankers. We thought it would be useful to extend invitations to bankers as well, because they are an essential part of the ecosystem supporting landlords. The agenda for today's call covers, first of all, an EMEA update on the macroeconomic situation resulting from the corona pandemic, followed by the local Romanian perspective for all major commercial real estate sectors, namely offices, retail, and industrial. We will also update you on the investment market, and Luisa will host an update on property management, which probably is the discipline within our company at least that is more busy than ever before, being in the front line of the current corona pandemic. A kind request before getting started: if you have any questions, please use the Q&A function, which is the mid-bottom of the screen. At the end of the session, we will try to answer as many questions as possible in our Q&A. Note that this call will be recorded and that we'll be sharing the recording after the call to all of you, so you can listen back to what was discussed during the call should you miss certain parts of it. Now, let us get started. First, we'll present you with a few slides on the latest macroeconomic outlook and how such outlook has been impacted by the corona pandemic. I therefore hand over to Jos, who will update you on the wider economic context. Jos?
Thank you, Gijs. I would like to share our latest views that can be split into two parts. I would like to start with the latest state of the global and the European economy, followed by the European investment market. Let me start with the economy. The virus curves, as they call it, are bending in the developed economies almost exactly as predicted. Testing capacity in these markets is unfortunately not as advanced as we earlier predicted. This points to a slow and phased end to the lockdown, which will be rolled out over May. And this could mean a potential return to economic growth in the third quarter of this year. Fiscal and monetary support for the global economy has been unprecedented so far, and we see more to come in the US, Europe, and Asia. If the second wave of the virus can be avoided or managed effectively, this policy support points to high rates of growth potentially for 2021. However, it is very early days. CBRE's current house view on the global economy is broadly in line with consensus, where we see Western Europe expected to see a decline in GDP of at least 5% for 2020 as a whole, with a weak Q1 and a brutal Q2. The large fiscal and monetary stimulus now implemented across Europe should support the economy, and this stimulus is designed to keep businesses and households solvent during the period of restrictions and lockdowns. National measures have been supported by an EU support package of 450 billion euros, reflecting the size of roughly 4% of EU GDP. Sharing the burden has become an issue in the EU recently, and within the euro area in particular. Although still opposed by some of the Northern European member states, a one-off Eurobond is still a possibility. Generally, office-based jobs will be less affected than others, such as retail, leisure, and hotels. But office vacancy rates are still likely to increase across the majority of Europe. The current house view sees a loss of at least 5 million jobs across Western Europe as a result of the crisis, and this may increase further. And despite the fact that negative news is still prevailing, Measures taken are really powerful to support demand and the flow of credit to the economy. And it is important to remember that Europe is acting much more quickly than it did during the global financial crisis. Some European markets are showing initial signs of new infections having peaked and are lifting bans where possible. Most of these markets were amongst the first to apply lockdowns, including Austria and Denmark, for example. As a result, we remain optimistic that an economic recovery can take place this year. But for now, it is key that the outbreak of the virus will be kept under control across all of Europe as a priority. Understanding the level of resistance the society has built up to the testing is now a priority, and the next few weeks are likely to be focused on testing and data privacy related issues. Then briefly, the state of the European investment markets. We just closed our Q1 investment volumes across Europe, and the main conclusion is that these numbers are not representative of the current market sentiment. Q1 2020 was the best Q1 on record. Strong carryover of a number of large-scale platform transactions initiated in the second half of last year caused Q1 to become a very strong start to the year. Corrected for these, Q1 still ended up 13% positive compared to previous Q1. As a result, the true impact on the investment market will only become visible in the Q2 data. Strong positive results were found in some of the larger markets, such as Germany, France, the UK, Spain, and Sweden, with the Netherlands showing a slight decline. In terms of sectors, multifamily, and a bit as a surprise, the retail sector showed strong gains Q1 on Q1. In terms of yields, we are seeing strongly diverging trends, with, on the one hand, some markets having shown some yield compression, examples being France and Germany, with yield compression till very late in March in France. The general acceptance, however, is that these will be the lows before potentially seeing some softening depending on the sector. In other markets, particularly in Southern Europe, yield softening is already visible, particularly for hotels and retail, generally up roughly 25 basis points Q4 on Q1, but pressure increasing across the board. And since the end of March, investment activity has decreased with an increasing amount of deals affected. And what we see is that bid-offer spreads have emerged in a number of Western European markets and sectors with potential discounts of 5 to 10%. The key points from my point of view are, firstly, that the impact of the virus on the real estate market is increasing in Europe, and the true impact will be felt during Q2. Secondly, until recently, most signs were on red. However, slowly but surely, the lockdown procedures in place seem to be paying off in Europe, with some indication of partial reopening of national economies. And thirdly, to avoid a stronger impact, all parties in the industry should work together by showing flexibility and build long-term partnerships. I'm handing over to Gijs now, who will discuss the situation on the economy and the investment market in Romania.
Thanks a lot, Jos. Now, we'll zoom in on Romania and its economic outlook. As the crisis persists, such outlook has unfortunately worsened, as can be seen from the revised forecasts projected on the screen. Romania here does no longer escape from a recession, and like other countries across Europe, will enter negative GDP growth in 2020. On a positive note, however, the Romanian economy is now expected to recover even stronger in 2020, with GDP growth revised upwards to a level just over 4%. This implies that Oxford Economics, which is the source of the data we are using, thankfully maintains its view that Romania will experience a V-shaped recovery, which is the most favorable of the various recovery scenarios, as it would imply that the recovery would be strong and imminent. Other scenarios, such as, for example, a W-shaped recovery, cannot be excluded. The W-shaped recovery would, for example, occur if we'll have a second wave of infections, which could push the economy back into recession on the back of such second wave. One of the immediate consequences of the corona pandemic has been the weakening of many emerging market currencies against the euro. The RON, the Romanian RON, is no exception and has also weakened against the euro. We must mention, however, that some other CEE currencies, such as the Hungarian forint, have weakened more than the RON. Of course, this impacts especially the retail sector, Even if rents are euro denominated, the affordability for retailers will suffer because their margin will be further scrutinized by the currency impact. It's also one of the very few inflationary pressures we currently see in the economy. I will now move on to discuss the expected impact of the corona pandemic on the Romanian real estate market. First, a few words in this context on the investment market. The good news is that there are some positive bits and pieces of news within an overall market, which is obviously very slow currently. We continue to see that some of the more advanced discussions currently underway in Romania are continuing. For example, CBRE held a red flag meeting on an ongoing logistics transaction the week before last. Obviously, the pace of progress of these ongoing transactions has come down, as various transactional aspects simply do take more time to be resolved. On a positive note, it seems that there is also more focus from the various transaction teams, probably one of the very few positive side effects of A, the drop in new business opportunities. People have not much else to do in terms of new business opportunities, so they can focus on what is ongoing and what is advanced. And secondly, B, on terms of working from home, which of course gives to some extent, depending on the family situation, I would say, more productivity opportunities to people. This may indicate that the hopefully temporary collapse of the sale of Nepi Rockcastle's office portfolio to AFI was an isolated case and not representative of what we're seeing in the wider market. New launches, however, remain exceptionally rare, mainly due to the ongoing travel restrictions, which make it very difficult to basically launch a product as people need to see it. There are very few exceptions to this, mainly related to non-income producing assets. There, of course, if there's no income which could be affected by the corona pandemic, it's easier to do the underwriting, because only short-term impact is considered when we speak about income-producing assets. CBRE, for example, launched recently a very large brownfield plot in Bucharest. The seller, in that particular case, decided to proceed with the sales process, regardless of the corona pandemic. And surprisingly or interestingly enough, investor interest is higher than expected, with several investors having signed NDAs. The challenges imposed by limitations in movement will be addressed to the extent possible by organizing virtual site tours. We'll be using drones to give people at least some indication of the opportunity presented. Of course, this will not fully replace a physical visit, but it's a good way to start experimenting with new technologies and how they can facilitate site visits without actually visiting the premises in the first stage. What about early stage processes? There is a large cluster of those as well. I would say that they are largely on hold at this moment because they're not far enough advanced that parties feel they can close them, and at the same time, it has already been launched. What we see in these cases is that some investors, however, start to look again at such opportunities. There is an increasing number of investors, mainly, however, on the more opportunistic side, that becomes active again in terms of exploring opportunities and revisiting cases that were already launched in the past. What does this mean for investment volumes in Romania? Jos already mentioned that Q1 2020 was very good across Europe. We also saw a trend in Romania that showed an increase, unfortunately not by 13% as it was European-wide, but I think by 3% in transactions for Romania. Again, it's not a representative situation. And we believe that overall investment volumes in 2020 will be impacted adversely by the corona pandemic. We are counting on a decline of transactional activity by roughly 50%. And we hope and we expect that only in 2021 we'll be back to the levels that we saw in 2019, namely just over 1 billion euros. We maintain our view, and that's why we're also optimistic on 2021, that demand for property as an investment class generally will not be impaired by the current pandemic. Then, looking at the bank financing market, what we see there is a continuation of the already mentioned relationship lending trend, meaning that banks are open for business, but they prefer to deal only with existing relationships. Conditions have worsened. LTVs, loan-to-value ratios, are somewhat down, and also margins have edged up. As a result, the positive impact of gearing on property returns has obviously somewhat declined. The impact of the Condora pandemic on property prices in Romania remains difficult to assess. Why? Because there is a lack of transactional evidence. We haven't seen any recent transactions that could be taken as a benchmark to judge the impact of the Corona pandemic. If we look at other more core CEE markets, we see that in certain transactions, small price discounts, indeed in the 5 to 10% range, were demanded by buyers on the back of the Corona pandemic. An important point, however, in this context is that capital values for prime offices in Bucharest on the onset of the pandemic were circa 50% below those in, for example, Prague. The reported prime office yield in Bucharest as at Q4 2019 was 7%. And that was probably lagging the market sentiment that we saw in the beginning of Q1 2020, where investors were discussing yields that were below 7% in general. As a result, one can argue that in the short term, Romania should not see much, if any, outward yield movement in offices or logistics. We only have inched upwards at CBRE, the prime retail yield, and we have done so by 25 basis points. This to reflect the more severe short-term impact that pandemic-related restrictions are unfortunately having on this sector. We remain, however, of the opinion that the longer-term impact of the Corona pandemic on pricing is likely to be neutral on the back of consistently high demand for property, as well as the ongoing attractive yield spread between Romania on the one hand and other CEE markets on the other hand. I now would like to give the virtual stage for today to my colleague Luisa Moraru, who will provide you with an update on the state of affairs in the retail market. Luisa?
Thank you, Gijs, and thank you for the positive view. I kind of share it. I will, however, start with the bad news, but bear with me, it does get better with retail as well. A bit over a month of lockdown into the lockdown, and short-term prospects for retail seem quite grim at this moment. With almost no sales, some retailers are likely to restructure their store network, or even in extreme cases go insolvency and even bankruptcy. The food and beverage and entertainment sector was probably the most hit, and might look very different at the end of the crisis, with vacancies expected to be as high as 30% by the end of the year, or even higher. Short-term income, which can amount anywhere between 5 to 15% of the long-term revenue of a shopping center, will be virtually non-existent for the most second half of 2020, regardless of how long the closure takes. And as expected, collection rates went down dramatically. The collection rates for April are at this moment between 10 and 20%, and May collection is expected to be even lower. As such, beside the shorter measures that landlords have taken on cost saving, landlords are already starting to discuss with their banks to defer payments and change terms, and are treating the talks with retailers very maturely. Most, if not all, retailers have already requested rent reductions or rent holidays for the lockdown period. Furthermore, many, and I would say more than the majority of the tenants, are starting to announce a push towards discounted fixed rents and turnover rents going forward, for fear of the duration of the consequences of this lockdown. Landlords are trying to understand each retailer demand and treat them fairly, while bearing in mind that they need to service their own obligations. As such, there is no unified approach on the landlord side. Few proactively waived both rent, service charges, and marketing for a limited period, while the vast majority took a wait-and-see approach in order to better understand the immediate consequences, and are now offering only rent delays. So I think it's fair to say that 2020 is somewhat compromised in terms of results, and everybody is focusing on putting the basis for the year to follow. But what has happened, which is very important in the past couple of weeks, is that landlords and retailers started to talk. faintly still, without major deals being struck, but they are at the table. And I think one thing that finally happened on the Romanian retail market, and not only, is that everybody understood that their future is strongly linked with the future of their partners. So the better retailers do, the better landlords do. And I think this is a clarity in everybody's mind that will define what happens next. But in day-to-day life, it will not be easy to convince customers to come back to the malls. As incomes are dropping, unemployment rates are increasing, obviously, and the fear of getting infected in public spaces is still very high and will continue to be very high. And the retail sector, frankly speaking, will not recover until customer confidence is not back to the fullest, which will happen. Smart management of shopping centers will be vital going forward in taking the right steps to slowly rebuild the consumer trust and give back the shopping centers to their clients. Managers have to redefine all areas of the mall and implement safety and social distancing measures while having in mind that they don't need to infringe the feel of freedom and excitement that the shopping center needs to convey. The ones getting this right will be the ones winning the race to the customer trust. The way we do marketing will fundamentally change as we redefine the customer journey, both physical and digital. The level of technology in shopping centers must increase, and now it is a must, with a large span of tools available and usable for all areas of functionalities. We believe that omnichannel will evolve with an increased speed going forward. Retail and logistics will integrate more, and shopping centers will have to adapt. And this goes into the way we merchandise the goods, the way we sign the contracts, and in the way we basically tell the entire shopping center story. It is, however, important to say that while generally online sales increased during this period, albeit from a very low level of 5.4% online penetration in Romania. So while generally online sales increased, retailers that had a strong online presence before, a sales, marketing, and delivery platform that were equipped for this model, and a clearly defined and active strategy for omnichanneling are performing much better than those who are focused on brick and mortar. So we believe this is the investment side on omnichanneling and will be very significant in retailers, and those who will get this right will be the ones again winning this new race. In conclusion, yes, clearly retail will change yet again. New concepts will appear, different functions, different ways of selling and buying, and why not different contractual arrangements. Our job is to prepare the malls for the new retail, making use of all the tools and all the knowledge and that our fantastic network gives us. Very importantly, some shopping centers will respond to the new requirements and will be able to adapt and redefine to this new reality. And they will survive, and more than that, they will thrive. Others will not. And I think everybody needs to be aware of this reality. Kai, to you.
Thanks a lot, Luisa. It was an interesting summary, I would say, and I really hope that shortly we'll have a between brackets reopening date, so we can work towards that when preparing ourselves for the new post-pandemic environment that you just outlined. If I look, for example, at the Czech Republic, where I currently live in exile, I may say, the government announced that all shopping centers will be allowed to open on the 8th of June, which gave the industry the certainty that it needed, because so far it was kept hostage because there was no clarity on when it could reopen. We still see that, for example, in the tourism industry, which is still paralyzed, at least in our country here in Romania and in many other countries, because there is no clarity on when people can start visiting hotels, the beach, etc. again. And yeah, I think it's very important that we get clarity on that so we can prepare for the next phase. The good news is that from this call, we now have passed, if I may say so, Luisa, the bottom of it, and we move on to sectors that are clearly less impacted than retail. Therefore, I would now like to hand over to Razvan Yorgu, who will update you on the office sector. Razvan?
Thank you, Heis. It's a new reality for all of us. And the truth is that it's been hard to understand and manage how to live from home, not just work from home. However, if we go to the office sector, we can say that office constructions are moved as planned and on time. The likes of One United, Skanska, Vastin, Forte Partners, Tiriac, and others are moving ahead. However, for the existing office buildings, we have seen a significant drop in usage during this COVID lockdown. Leasing-wise, we have seen that large deals that were in advanced stage of negotiations are moving along, while the smaller requests or those that are not HQ-driven have seen a slowdown in the process. As some of you might have heard in our CEE call from last week, in general, the number of canceled office projects leasing-wise has been low in CEE. Existing occupiers, depending on the industry and on how pandemic has affected their business, think for example of IT versus travel agencies, are asking to renegotiate financial terms, mainly but not exclusively asking for rent deferral for Q2, with some asking for the entire 2020. In general, considering a slow Q1, down 50% compared to last year, we estimate that 2020 has chances to be half of the leasing volumes from last year, with renegotiations and take-up having a 50-50 share compared to 30-70 last year. As you mentioned before, Heis, real estate is a business of palpable objects, and not having the option of on-site visits and tours is quite challenging for the office market. For occasions when going there in person is not possible, there exists a range of 3D interactive tools that are enabling users to conduct virtual site visits to visualize how buildings might look in the real world. Floored, eye staging, panorama, tableau, these are tools that exist in our digital portfolio, and we like to think of ourselves as tech savvy. So feel free to ask us for a demo on digital, and we'll gladly organize one. Looking at the leases that expire this year and next year, there are approximately 300,000 square meters that will decide what to do next. Around half of this will turn into a renewal or a renegotiation solution, and the other half might lean towards existing or pipeline projects. The new demand will be generated by IT, software, BPOs, telecom. You have to remember that Romania is known as a cluster of IT companies. Workplace transformation. Today, a key aspect of interest for all our occupiers is how to secure future safety, health, and well-being of their employees. Social distancing is actually the main driver against the tendency to reduce space due to work from home that so many talk about. Trends like de-densifying, flexible hours, flexible working hours, extended office hours, rearrangement of office space are on everyone's agenda. What we did in CBRE is to put together our office agency, our project management team, our workplace consultants, and we are actively working on tailor-made solutions for our clients to maximize their health and safety. The current situation will continue to influence our behavior in the next period. Almost all companies plan to increase their investment in technology on one side and to increase their adoption of flexible working on the other. We believe that this outbreak will lead into a larger preference for buildings with strong well-being and environmental features. This is the major opportunity for the new projects out there. So, investing wisely in those measures that count, and more importantly, communicating them with your occupiers will make the difference in tenant relation for the coming months. This period of business uncertainty is a chance to build stronger partnerships between landlords and their existing tenants. To conclude, I would say that this is one unique unprecedented and transformational moment, and it will have an enormous impact on the culture of work. On one hand, we have a mass introduction of digital tools that will bring productivity gains for the companies. On the other hand, the enforced work from home on a massive scale will reset the core values of the office. Almost all of us are now able to work from anywhere, but we will choose to come to office to meet, to discuss, to collaborate with our peers. The new office must, and I would like to repeat that, must deliver the optimal platform for this experience. That's it for me, Heis. Thank you for the office sector.
Thank you very much, Răzvan. And I believe I speak for most of us if I state that I personally can't wait to come back to the office and meet up with clients and colleagues, of course. I'm not saying that because you're part of the audience, but I think we all miss the interactions with colleagues that Zoom essentially can't facilitate to the same extent as a personal meeting in the office or around the office. Now we go back to Louisa, who will share her views on the impact of the corona pandemic on the property management discipline. Louisa, there you go again.
There I go again. As you said before, it has been some intense couple of weeks for the property management teams in CBRE, in which our primary focus was on the well-being of our occupiers and on ensuring the buildings are well maintained and ready for reopening, while at the same time keeping costs at the lowest possible level. There is a lot to say about the cost-saving measures that we've been implementing, while keeping an eye to the medium and long-term damage that this may cause if not done responsibly. I will, however, say that there is this much cost-saving that can be done, and the numbers may even seem impressive in some cases, with 35 to 40% of service charge budgets down. So there will be so much cost saving that can be done until the buildings are fully automated and technology is embedded in their operation. This seems to be a theme over the discussion here, but it is really important. At this moment, the need for energy efficiency tools, automated maintenance software, cleaning robots or offsite security solutions and things like that is becoming more and more clear, especially when we acknowledge the fact that the new reality is likely to bring more costs as health and safety measures are coming at a price. We're already working on the reopening strategies, answering that very difficult question on how we give our occupiers the confidence that they are safe entering and using the building. We are, of course, in permanent contact with all the relevant authorities, local and global, to understand and implement their recommendations. New workflows and new procedures are being drafted in close cooperation with landlords and tenants, and we're confident that we will be able to create the safe and welcoming environment that users of the buildings are looking for. We're redefining common areas and their servicing by creating clear traffic corridors, specific health and safety measures, and rethinking the servicing model of our suppliers. Proactive and clear and frequent communication with tenants and with the public with regards with everything that is available for them in the building will be essential in order to ensure that all these measures are effective and appreciated. But apart from what we clearly need to do at this moment, we are thinking of what the new occupancy trends, as those Răzvan already mentioned earlier, will mean to operations. For instance, we expect the operating hours of office buildings to be longer going forward due to flexible hours and working in shifts. As such, the operational costs of the buildings are expected to rise in a moment when cost efficiencies are essential. We're also rethinking the logistics of food in office buildings. How we'll be able to provide food options to all occupiers when cantinas are not yet equipped for the new environment, or in many cases, or why not even opened yet. The restaurants on streets will likely open later on, or many of them will not really reopen for a long time. And what do we do with the couriers delivering food? Are they allowed in the building? So this is the kind of questions that we're trying to answer at this moment to give efficient solutions and to embrace the new reality. As a conclusion, it is quite clear that until a vaccine for COVID-19 is not widely distributed, people will act differently while accessing any building. And probably some of these measures that are now being implemented will become norm. With the focus on operational costs will remain extremely important for the next couple of years for occupiers. And as such, property managers will need to come with creative solutions to incorporate the health and safety costs in the current budgets. And more than that, to make you the best use of this opportunity to create an emotional bond between occupiers and their workplace, which will play a very important role going forward. Gijs?
Thanks, Louisa. It's, as always, fascinating to see the great diversity of topics you have to deal with property management in the front line, especially in the current pandemic. And I think the good point, at least that I took away, is that the need for cost savings and, let's say, accommodation of the new social distancing, etc., will at least hopefully trigger some actions that could be beneficial to all of us in the industry in the long run. So that's, I think, a very positive point to hear. Now I'll hand back to Razvan, who will brief us about the industrial sector, which probably, at least partially, I would say, is currently experiencing its heydays. So Razvan, there you go.
Yes, Gijs, you're right. You're totally right. Industrial has been called many ways in the recent years, from Cinderella to the rising star. We like to call it these days the Netflix of the real estate world. And I'll explain in the end why. So coming back to earth, development in industrial, so all construction sites are proceeding as normal, while speculative developments might register delays. Pre-lets are going as usual. There are approximately 600,000 square meters under constructions, and 70% of that is pre-let. Financial terms. In general, the trend for rental holidays, rental discounts, delayed rental payment is significantly less visible in logistics versus the other sectors, like Louisa mentioned in retail earlier. We expect this, however, to catch up with the general European trend, where many more occupiers, especially automotive sector, have asked for such re-evaluation of financial conditions. As principle, landlords have given deferral in rental payments only associated with lease prolongations. The good news is that automotive plants are reopening partially or are planning to do so. However, the suppliers are getting under pressure with only small production volume expected in the beginning of the operations. With customer demand in automotive dropping to historic lows, one of the main concerns is also the storage of already produced goods. Prime rent is stable at the moment, with obviously a potential push from tenants for extra incentives on, and those lowering the net effective rents. In other words, there is no visible reduction of the headline yet, but in some ongoing negotiations, we saw additional incentives granted by landlords. Demand, the pre-existing requirements before the COVID-19 pandemic, these are generally ongoing. We have seen some delays in finalizing them, but none so far for already signed agreements. New requirements caused by this situation we face. Obviously, e-commerce. While some pure e-commerce retailers have seen an increase in demand in various categories, cleaning, electronics, DIY, but this has not been the case for all, especially apparel, shoes, and likes. In general, the increase in demand on this short-term period has been accommodated by the surplus space existing already, retailer facilities or 3PLs. We might see optimization and new demand in the logistic area from some retailers, especially those who are primarily brick and mortar and want to increase their market share in the online environment, for which logistics and distribution is key. Also, an unprecedented digitalization of consumers in the past weeks means that the online grocery sector has strong prospects to grow, generating increasing demand for new warehouses, including controlled temperature ones, which today represent only 16% of food retailer warehouse. In general, niche markets are expected to thrive in the coming months: cold storage, oil storage, even data centers. A lot depends on how demand from consumers shapes up in the coming weeks or months after the cease of lockdown. New demand from potential relocation of certain production facilities from Asia or reshuffle of new production within the European continent might be seen in Romania in the next 6 to 12 months at a stage of analysis, with actual development in the next 2 years or more. Romania continues to compete for these assignments, however, with the countries in the region. Contracts up for expiry this year, we see here a trend of prolongation from occupiers as the general level of uncertainty remains high. Historically, our industrial market was driven by new demand and pre-leases, 70% of the market. For 2020, the scale might favor renegotiations and prolongations, which we assume to be up to 50% from the 30% market share previously. There is a question here about potentially restructuring of lease agreements, like it's happening in retail. The answer is that this will be difficult because one of the core pillars of logistics and industrial is the dedicated requirement, and this can only be covered through a build-to-suit project and less by speculative development. Mid to long-term aspects, one would be going back to core business, especially for occupiers' need for cash. Thus, we expect sale and leaseback opportunities from automotive industry, and why not owner-occupied retailers. Or, for example, coming back home, the reshoring or nearshoring that I was mentioning earlier. During this crisis, companies, sales companies, production companies have been the most affected. But the companies in the middle section, those related to warehouse, stocking, and transport, midstream companies, have been privileged. And this is why I'd like to come back to the promise from the beginning. Imagine warehouses are like Netflix. Hollywood production is rather limited, cinemas are closed, but we are all watching Netflix. It's the same for e-commerce. Logistics have filled up the void generated by traditional retail being closed, giving strong fundamentals for the long-term evolution of this sector. In principle, the perspective for industrial is optimistic going further. Yet, we have to make a distinction between the future of each industry, as future will not be the same for everyone. Thank you, Gijs.
Thank you very much, Razwan. I must say that for me, as an investment person, I liked very much what you were speaking about manufacturers going back to basics, which basically would mean that indeed they would potentially dispose of non-core activities like owning their properties, which again could help us with respect to getting more product available in this sector. Because like you said at the very beginning, when you made the Cinderella metaphor, it's indeed true that there is a lot of latent investor demand for logistic property in Romania, but at the same time, supply is very limited. And this could maybe address that issue. So that's an interesting point for me at least. We've now finalized our update for today on where the market stands, and we hope it was comprehensive. We're now ready to go through the Q&A. I see that the traditional Q&A function that we have in this webinar is not really being used. I see one open question. Thankfully, there are coming a few more in at the moment. So let me start with the first one, which is, let's see, what is the impact on street retail, high street retail, stores located on the ground floor of blocks in Bucharest when we speak about vacancies, rents, and yields? Luisa, can you maybe address this question?
Sure. Thank you very much for this. Actually, it's a very interesting topic that we're thinking about to see how it will evolve. On one hand, it is good that we don't have the strongest high street because we do expect quite a lot of vacancy because as retail has been closed, many of the small mom and pop stores will not unfortunately be able to survive, especially these sectors and the more affected sectors such as fashion. However, the vacancy overall probably will not increase by more than, let's say, 10–15%. Rents are likely to decrease almost at the same rate, while yields will follow the general trends on yields. Overall, the impact on street retail in Bucharest will be probably lower than, probably significantly lower than that on shopping centers. So from this perspective, high street retail is quite protected at this moment. Gijs, you're muted.
Sorry, too many multitasking going on. Apologize for that. Thanks for the answer. Hope it was clear, Louisa. Next question is from David, who was asking if we see a move from business process outsourcing and shared service centers back from the Far East to Central Eastern Europe and Southeastern Europe. Razvan, may I hand that question over to you? Because I think it kind of ties into what you're also saying about the industrial sector earlier.
Yes, actually this is one thing we are expecting as going ahead, as Romania has, or in Bucharest, has been proved to be a very functional country in terms of work from home, compared to what we hear from Far East, China and India as well. So, as I said in my industrial comment, we'll see it only at the stage of analysis in the first 6 months, while the relocation we estimate to take longer. But this is something we're looking forward to.
Thank you very much, Razvan. I will now briefly step into the chat function because there are also some questions, and then go back to the Q&A function. There's a question from Anna at Skanska, which is asking, when do you foresee that transactions will start back? I think it's a good question, of course, and we are eagerly anticipating that moment for those transactions that are on hold. When will they be resumed? I think 2 conditions probably have to be met. I think the most important one is, of course, the lifting of certain lockdown measurements that currently are in place. I think, in one hand, they don't per se, at least in Romania, prevent transactions to happen. But at the same time, given the fact that they're not uniform across jurisdictions, I think they are an obstacle in substance. And I think secondly, of course, the traveling limitations that currently are in place are another very important limitation, because you can do, theoretically, I think, a transaction largely from Zoom, but at the same time, you need certain documents to be obtained from authorities. You need a notary to go through. And you need, of course, to usually sign the documents, at least the power of attorneys, and at least the lawyers have to sign then, once being granted the power of attorney, the transactional documents live at the notary. So in that context, I believe once lift of restrictions has happened, and once the travel options are again back on the radar screen, that we will see also cautiously transactions to be resumed. Of course, then there is the question whether the parties that are at the table at such a transaction are, let's say, both still interested in doing the transaction at the terms that were agreed pre-corona. And I think there it depends a lot on what has happened to the NOI of the respective asset. And again, I think the impact in offices or logistics, industrial, is much more limited than on retail. Retail, it will be uncertain what is the NOI if you resume a transaction. It will have to be updated, and that may take a time because certain, let's say, demands from retailers versus their landlords will need to be formalized. In offices, I think this will be much easier. So within, let's say, a very short period of time, both the buyer and the seller will have a clear view on the situation with respect to the NOI and can resume the discussion. And then the second question, also from Anna Skanska, is, are tenants looking for flexibility in their leases, and how will investors react to that when it comes to transactions? Because of course, and I see the point there, when we look usually at office transactions, if you would like to get the core yield, the prime yield, yeah, you basically are speaking about an office building, a new office building with at least a WALT, the weighted average unexpired lease term, of 5 years. That's kind of the market benchmark for prime yield. What is currently under discussion in certain cases is that tenants need more flexibility. So that can be in surrender options, that can be in shorter lease agreements, etc. And of course, this is something that in retail has been common practice for a long period of time. When we're not speaking about single tenant boxes, but we're speaking about shopping centers, I don't think many investors, especially specialized investors, really cared about the WALT. Yeah? It was something that people actually saw as an obstacle when it came to retail assets, because the shorter the WALT, the quicker one could anticipate upside potentially. Yeah? For offices, it's always been a bit different. On the one hand, people are, or were at least just before the Corona crisis, were pricing in rental growth upside in many markets, not per se in Romania, but I'm speaking generally here across CEE. They were pricing in rental upside. And then, of course, you prefer a shorter WALT. However, I think the vast majority of investors were still appreciating a WALT that was as long as possible, because they valued more the risk protection that a long WALT gave them than the potential upside they would forgo on. And I think there will be indeed a reconsideration of the importance of the WALT. It all depends, I think, on how investors will look at this in the context of the discussion on demand. If investors are comfortable that demand will not be impacted long-term by the current Corona crisis, they probably will be more relaxed when it comes to the WALT. I think the second point relates to bank financing. Banks typically also were appreciating a longer WALT and were adjusting the conditions that a lender was giving to a borrower based thereon. If banks become more comfortable on a shorter WALT, I think investors will probably partially follow suit. So I think it's too early to see how it will play out, but there are examples from other sectors, basically where a short WALT was already common. And I think even within the office sector, just to wrap it up, even in the office sector, if you look at existing office buildings, it's very, very close to impossible to have a WALT in excess of 2.5 years in a market where the typical lease length is 5 years. Because once a building goes through one or more leasing cycles, you almost never will be in a position as a landlord to sign lease agreements to such a way that you have a WALT which is more than the mathematical average, being 2.5 years. So I think there, you of course see that there is a yield discount for existing buildings usually. Yeah, but again, that discount is probably not only related to the WALT, it's also a result of, let's say, the shorter lifespan of the building left. Yeah? Because older buildings, of course, also get a penalty because there will be higher capex, maybe they're functionally more obsolete, etc. So I think there are many angles to look at that, but I agree that this will most likely become a topic in the near future for investment transactions as well. How investors will be dealing with a shorter WALT that may be the result of tenants demanding and seeking more flexibility. Good, then we move to the next question. I see here a question with respect to potential for Class B offices and refurbishments. Razvan, would you be willing to answer that?
Yes. Obviously, there will be tenants that are or will be looking now much more into the savings topic. So we might see tenants that are not so focused anymore on accessibility, but rather on cost. And we might see some transactions like this. I don't think this will be a trend, however. Yeah, the general push will be for health and safety, and this is much easier to implement in a new building. If you take an old building and you refurbish it, then obviously this is a totally different topic. But I would like Hais to see the answer from Luisa to Lori's question, because I think this is a very interesting one today. It's a question we all ask ourselves.
Yeah, Luisa, you see the question, right? Which is basically
yes.
When a second wave would arrive.
Yes, thank you, Lori. This is indeed an important topic. One of the things that we're actually doing right now, and I think this is taking a lot of our time, and our focus is to define the health and safety measures that will protect us for the future. So we're implementing social distancing rules, but and all the usual, the obvious ones that the authorities are requesting us to implement, more or less. But more than that, we're looking at equipments. We're looking how to restructure the way the buildings are functioning, how to increase the fresh air impact into the building. So again, technology to be put on top of the HVAC systems and BMS in order to, again, protect the buildings from the spread of the virus. So basically, every action that we're taking right now is not only for the prevention of the spread of the virus today, when we think that the risk is a little bit lower because we've been all in lockdown and we've been protected. But what's happening in the next couple of months when this may take us again by surprise? As such, we're trying to think of ways of using the common areas of the buildings and the equipments of the buildings and the way we interact with the service company in order to protect, basically, from the moment when higher numbers of occupiers will be in the buildings. We'll be more than happy to share with you offline the health and safety guide that we've put together that is basically putting all these measures in one place and to maybe even discuss it with you in detail on how this can be done in your buildings. I hope this answers your question, Lori.
Thanks, Luisa. I see another question from Dennis Salinas, which is basically asking whether we think that the overall trend of working from home would have an impact on office demand in the medium to long term, just as social distancing could have an impact on retail traffic. Razvan, would you like to address that question?
Yes, I think I addressed it very little in my initial intervention. So we have now two forces that clash. Yeah, the work from home that might generate some space reduction for tenants as they realize they can be more efficient with their office space, and the social distancing that is especially valid for Romania, I would say, where the density in the office building was above the medium in what was happening in the region. So I think the offices that we have in Bucharest were quite dense before, and now this pressure on social distancing will come to clash on the effort to reduce office space based on work from home. However, it is too early to say how this will impact the general vacancy rate in Bucharest. Yeah, it is a concern, it is a valid concern, but it is too early to comment on it. Jos, maybe you have something to add.
Yeah, I just wrote back via the chat to the person who raised the question. I think in addition to the rationale that you give, which I'm fully behind, by the way, there is the need for additional services required in office space in the fight for talent. And obviously at the moment that is less relevant, but when the market starts settling down again, this fight for talent will be on again. And incorporating services like health-related services or well-being, spa facilities, these kind of trends are another aspect to consider And it wouldn't surprise me personally if actually the need would go up for the amount of office space that a company would be taken, driven by all these factors. But as you said, it's too early to call, Razvan.
Thanks, gentlemen, for elaborating on that one. And then we have a question about land prices in Bucharest and in the other 10 main cities in Romania. When do we expect the market to revise downward valuations and prices? And I think maybe Razvan, I would ask you to address it. I spoke already briefly about the general investment market. It's too early to really assess what will be the impact, at least in Romania, on pricing. Of course, except for cases where we see a clear impact on the net operating income. For land transactions, of course, there is no NOI at the moment. It's more about the assumptions that buyers will make when it comes to their future exit, the development yield that they can generate. So maybe you have a view on that, Razvan, knowing that you are, I think, from all panelists, the land specialist.
I'm on the spot here today, so good. Thanks for it. When you talk about buyers, the good news is that you see them willing to look at the market if they get a land at the new price or at the price they call it the right price given the current situation. However, we have to consider that we will only have a transaction when the sellers agree to that as well. And the counter argument, one of the counter arguments on the seller side is that we've been through one crisis before, 10 years ago, and land prices slowly got back to the prices before the crisis. Obviously, it's not the case for the exaggerated transactions, let's say, but for most of them, land prices got back to normal. So my assumption today is that we will only see land transactions at new lower prices with those sellers who have to sell, with the ones who had to liquidate their assets. With banks, maybe, why not? But it's clear that buyers will put a pressure on land prices for all sectors, not only office or residential, but they will put on pressure on all prices, maybe except industrial.
Thanks, Razvan. Then there's a question from Janina Unguranu, which basically is that there is a battle on cash right now. And how do we see this dynamic between the landlords and the retailers when it comes to cash? What would be a fair solution for this period, meaning the lockdown period? And what about after the lockdown period? Do we see the state stepping in? Louisa, would you like to take this one?
Yes, thank you, Janina. I think this is the question on retail these days. You're right. There is indeed a battle of cash, but I think that what is important is not what's happening, what's the solution for now, for 1 month or 2 months or 3 months. What is important is for us to have a bit of a longer view. Why am I saying this? Because retailers have no sales, and many of them don't have money to pay, no matter how much we charge them. Many of them have. That's absolutely true. The reality is that we need to see what the future will look like, how many retailers will reopen when we reopen. We need to see how retail will look and how our contracts will look like. So I think at this moment, the big question is not, the answer is not within the actions that we're taking in March, April, and May, but how we sit at the table with retailers and how we approach every conversation, every sector, how we look at the sales and their business, and of course, how we transform this into a contractual relationship going forward. This will probably be the key in the successful shopping centers. Those that will maintain most partners, those will be the ones that will thrive. So they're on the stage. I strongly doubt that we can, that they will involve themselves more than they've done on the social measures and maybe with a little bit of relaxation on the financing side. I think this is a conversation between landlords and retailers. And I think this is a conversation on a long span. I think this is the key word here, the long-term relationship. I hope this answers your question, Diana.
As we are starting to run out of time, and we are now already 7 minutes beyond our slot, we have one more final question to address, which comes from Brendusha Grama. Again, yours. The question is, did you notice any major differences when it came to landlord responses to tenants' requests across CE countries?
Thank you, Brendusha. No, the answer is no. There are no differences, to be very honest. I think this is quite valid everywhere, not only in CE, but in EMEA. So what we did, we put together the list of rent reduction requests everywhere and what the landlords are doing. And at the end of the day, this is what's happening. Some landlords are deferring rents and service charges and marketing with the view that this will support the business of retailers and support the negotiations going forward. Some have granted rent holidays, and the vast majority are just waiting to see. There are certain places such as Poland where the state intervened in the way that the state basically terminated all contracts in shopping in every retail property above 2,500 square meters, which basically means in shopping centers. In the UK, there were some direct state measures of forcing landlords to grant rent holidays to retailers for a period of time. But apart from where the state intervened and proposed certain measures, I think the proportion of landlords who are granting rent reliefs and rent holidays and doing nothing is pretty much the same everywhere. So no, and more than that, I think I can take this a little bit further to APAC or HICE, where it happened pretty much the same. So we're already at the next stage of negotiations in Asia, where people are already at the table. But we do see a reduced amount of landlords in the properties that have granted rent reliefs for the period of lockdown there, which is now closed. So we can see the end of that, let's say, in Asia.
Thanks a lot, Louisa, for your comprehensive answer. Again, as the time has unfortunately run out for our call, I would like to take the opportunity to thank you very much for being with us today. Also, especially grateful to the ones that have asked questions. We hope we answered them well. We will send, of course, around the recording as mentioned earlier, so you can listen in to specific topics that you found more of interest. And we will keep you posted in the coming weeks once we keep monitoring the situation, and we'll probably organize a follow-up call in the near future. In the meantime, we of course wish you all the necessary strength in managing your businesses, and please keep well. Goodbye for now and have a great evening. Thank you very much. Bye-bye.
Bye.